Hey everyone, welcome back. It's Alice and Bart, and I'm with Century 21 in Niceville.
I'm with Certainty Home Loans.
And today we're going to talk to you about whether or not you should use your tax refund to purchase a home. So if you're like most people, you might be getting that tax refund in the mail soon. And we're going to talk about 3 things to consider if you're on the fence about purchasing a home, whether you're renting or maybe you're living in base housing. So can you talk about those 3 things real quick?
Yes, absolutely. So when we're talking about a rent versus own analysis, one of the things that just about everybody thinks of is, well, how much would it cost me to rent a house versus buy a house? So like my March housing payment, is it going to be more if I rent or more if I buy? So that's one thing, just a kind of a cash flow analysis. And then the other one that is fairly obvious is the appreciation gain. Like if I buy this house today, what might it be worth in 3 or 4 years? So that's number 2, is appreciation gain. But then another one people don't often think about is the amortization gain. And that means if you've got a house loan and you're making payments on it every month, then you're actually paying that balance down. And when you sell the house, you'll get that back. So that's the third thing that we're going to look at today.
All right, and so to show you how those 3 things make this up, we're actually going to use a buy versus rent comparison tool, and Bart's going to walk us through how those three things can help you decide whether it's a good decision to use your tax refund to purchase a home.
Yep, and so what we're going to do is we're going to use a home that you've kind of recently looked at, right?
Right, so we're going to use a home where recently the owners were considering selling their house. They currently use it as a rental, and they were able to find renters again, so we didn't sell it, but we agreed that the purchase price would probably be about $315,000. So the purchase price would be $315,000, but right now they are actually renting that home for $2,195 per month.
All right, excellent. So this is a real scenario.
Right, this is a good example from the Niceville area.
Now, what do you think? So, okay, $2,195 is their monthly rent.
It's current monthly rent.
Let's assume they're paying $28 a month in renter's insurance. How much are rents increasing per year on average in Niceville?
All right, so we did some number crunching for this one, and we looked over the past 4 years, and it looks like on average in Niceville, rent is increasing by about 3.75% per year.
Right, so we can use that number because that's a real number.
Right, it's the number for our area.
And let's assume that instead of renting it, they're going to buy it for $315. Property taxes are $2,268 or so. $92 a month for home insurance. Property taxes increasing about 2% a year. Is there a HOA on this property?
So for this home, there was no HOA, so we can take that out of there.
Okay. And we're going to assume 6% cost to sell the home when they do eventually sell it. And let's assume that this person is, in fact, a military or a veteran, as whether they're active duty or not, but they have the VA loan eligibility. So we're going to use a VA loan. I'll put that in here, and we'll use an interest rate for you of, say, 3.5%, because that's reasonable. I mean, it might be a little lower, it might be a little higher, but that's a good number. And then you don't have mortgage insurance for a VA loan, but you do have a VA funding fee. And let's assume that it's going to be 3.6%, which if it's your first time using VA, it's going to be lower than that.
Right.
But we'll go ahead and go with the worst case scenario, so to speak. We'll have that financed into the loan. And then what about closing costs? Do they have to pay that?
Well, it depends on the home, but hopefully if you have a good real estate agent like me, we might be able to negotiate, and maybe you can get in the home with 0 closing costs.
And I will say that's completely realistic.
It is realistic, yes.
Often, yes. And then let's say that they're going to own this house for, say, 4 years. Oh, that's 5, 4. No, I can't type 4. There we go. And then what about an appreciation rate? What should we use here?
All right. So again, we went and crunched the numbers for Niceville. And so the appreciation rate that we got for Niceville on average over the last 4 years is a 6% increase each year on the appreciation of your home.
And that was interesting. We actually looked at real numbers there, and that it was some years it was less, and some years it was more.
It was more, double.
It really worked out to 6% there. So we won't go over tax benefit of buying a home in this analysis, but we'll just kind of leave it at that for now. So that gives us all of our numbers. Now let's look up here and see what we have. The first thing we'll look at here is the cash flow difference. That's that first, most obvious kind of thing, right? This house, if you buy it, it's going to be a monthly payment of about $1,750 a month. If you rent it, it's going to be $2,200 a month. So, you're already looking at almost $500
a month in savings. Yeah.
But that house is going to go up. Likely, the rent is going to go up 3.75% a year because that's what it's been doing
Correct.
for 4 years. So it's likely to assume it's going to do the same. So you'll be at almost $2,500 a month at the end of that 4 years. So you've spent $112,000.
Right, and then at that point, that's almost $700 a month.
Yeah, different, right? Because this payment isn't really going to change.
Right.
It's just going to stay about the same. So just that there in the first 4 years, you're going to see cash flow difference of $28,000. So that's $28,000 less you will write a check for or have drafted out of your account over the 4 years. The appreciation gain, you want to talk about that one?
All right, so let's talk about the appreciation gain. And so this is talking about how your home value is increasing over the time that you're owning it. And so here we're starting out with a value of $315,000, and that's what you're purchasing the home for. And with our analysis of 6% on average increase per year in Niceville, after 4 years, the home is now going to be worth $397,000, so almost an $80,000 gain over 4 years. So that's a pretty substantial investment.
It's almost hard to fathom.
It is hard to fathom.
But I mean, really, it's an asset worth $315,
Mm-hmm.
and it's appreciating at 6% a year. So that's the numbers.
Yeah.
$80,000 in appreciation gain. It's going to cost you $23,000 or so to sell it.
Right.
So we'll take that into consideration. And then this last one that people often don't think about is this amortization gain. If you get that loan, you'll only owe $288 after 4 years of paying on it. So you've gained $26,000 in appreciation. I mean, in amortization there. So that's money you're going to get back.
Mm-hmm.
So this here is actual money you're saving each month for the 4 years that you've owned the house. These are numbers you're going to realize when you actually sell the house.
Right.
The increased purchase price over what you paid for it, and then the decreased loan balance because you've been paying it off. So let's kind of do all this together and see how the numbers show. You can see here that even considering the cost to sell a house of $23,000 with 6%, if you own it for 4 years, it's $113,000 better off to own the home than it is to rent the home.
Right, and the $113,000 isn't just the cash that you're going to make at the end of the transaction. This is an overall number of your savings throughout the process.
Yeah, so if you take this again is numbers that you saved every month for the first 4 years, and these are actual pluses at the closing table when you sell it, but this is a minus when you sell it. Mm-hmm. So you take plus minus, and you end up with about $82,000 left over is what we did the math. And that, if tax laws stay the same, is all tax-free money. So that, you sell the house after living in it, after saving $28,000 over the 4 years.
Right, so you've already saved $28,000 just by the 4 years each month.
And now you've got $82,000 tax-free being wired into your savings account. So, imagine that.
Based on our example, which is pretty typical of our market in Niceville right now, you can kind of see that buying a home versus renting makes sense based on this example.
Yeah. Now, there's going to be times where it may not be the prudent thing to do. Some couple of scenarios that come to mind. Maybe your employment outlook isn't very positive. You don't know, how that's going to continue. Some people are on that kind of contract basis or what have you. Or if your credit score is hurting right now. But I would encourage everybody to not discount buying a house without talking to a mortgage lender first and see if it's possible. Because a lot of people think that they couldn't buy a house, but in fact they can. And they can actually make a really wise decision by buying a house. So that can work in their favor for sure.
So if you're thinking about using that tax refund to get into a new home, please give us a call if you have more questions. You can call me or you can call Bart anytime, and we'll answer any questions you have.
That's right. You'll find our information on Facebook, right?
Yep.
All right.
We'll see you next time. Thanks.
Bye-bye.